Britain just posted the fastest growth in the entire G7. The FTSE 100 smashed through 10,000 for the first time in history, printing an all-time high of 10,910 back in February. Inflation is cooling. So, why is the bond market pricing Britain as the single most fragile economy in the developed world? And why are people across the age and wealth spectrums heading for the exit? Well, today we break down the debt trap eating the British state alive and look at why the wealthy, the young and the skilled are walking out the door all at once. My name is Guy and this is the Finance Bureau. Now, on the surface, this story kind of writes itself. UK GDP grew 0.6% in the first quarter of 2026, the strongest in a year and the fastest in the G7. The IMF actually upgraded its 2026 forecast for Britain from 0.8% to 1%, citing what it called strong pre-war momentum. Meanwhile, CPI inflation fell to 2.8% in April, down from 3.3% the month before. And the FTSE 100 has spent the year flirting with record highs, currently sitting around 10,313. Now, those are all real numbers, but they don't tell the whole story. You see, the FTSE 100 is not a measure of the British economy. It's a basket of global multinationals, energy giants, miners, banks, and consumer staples, most of whom earn their money in dollars and barely touch the domestic economy at all. When commodity prices rise and the pound weakens, the FTSE goes up. This is simply a currency effect dressed up as a recovery rather than a genuine signal of economic health. So then, where can we find a more honest signal of Britain's economic well-being? Well, look no further than the gilt market. Now, gilts are a fancy term for UK government bonds, the debt the country issues to fund itself. And the yield on that debt is the interest the government has to promise in order to find a buyer. Put simply, the higher the yield, the more nervous the lender. So, when yields spike, the market is telling you it sees risk. And in May 2026, the 30-year gilt yield hit 5.81%. That is the highest level since 1998, a year into Tony Blair's premiership, which began with Labour's 1997 landslide. Meanwhile, the 10-year touched 5.17%, the highest since 2008, the year Lehman Brothers collapsed. However, the real warning sign is the decoupling of these bonds, because government bonds usually move together. When global rates rise, US Treasuries, German Bunds, and UK gilts tend to drift up as a pack. That, though, is not what happened here. The US 10-year was sitting at 4.45% and German Bunds were lower still. But UK gilts ripped away from both, with the spread over equivalent US debt widening from 60 basis points to 78 in just 2 trading sessions. So, in plain English, the market stopped charging Britain the global rate and started instead charging it a very specific risk premium. Luke Hickmore at Aberdeen put it bluntly, saying the gilt market is pricing a risk premium not seen since before the financial crisis. And the research backs him up. The National Institute of Economic and Social Research found that political uncertainty around the Prime Minister more than fully accounted for the widening of the UK spread over Germany. And that phrasing is important because it means the entire gap was domestic. The bond market is reacting specifically to Britain's domestic situation, ignoring global trends. Saxo's Neil Wilson summed up the mood succinctly, quote, "The bond vigilantes are lurking." And here's why that's so dangerous. You see, Britain runs a current account deficit, which means it depends on overseas investors to fund itself. It relies, as one analyst put it, on the goodwill of foreign capital. Now, the recent buyers of UK debt are leveraged hedge funds and banks looking for short-term gains. In other words, hot money that can turn around and leave the moment confidence cracks. So you can think of the bond market as the adult in the room, and it's saying the UK is uniquely dangerous to lend to at this point in time. And by the way, if you want to stay on top of stories like this that actually affect your portfolio, then you need the Finance Bureau weekly newsletter. It's absolutely free, and we break down everything regarding global finance, commodity markets, macroeconomic trends, and monetary policy so that you never miss what matters. Just click the link in the description or scan this QR code to get started. And now, back to that risk premium, because the market's nervousness is driven by pure maths. Debt interest now costs the UK roughly £110 billion a year. That is 8.1% of all public spending, a 50-year high. To put it another way, £1 in every 12 the government spends now goes straight to servicing debt before a single nurse, soldier, or teacher is paid. And it's getting worse by the month. In April 2026 alone, debt interest payments hit £10.3 billion, the highest for any April on record. April borrowing came in at £24.3 billion, the second highest on record, beaten only by the depths of the pandemic. That was £3.4 billion above the Office for Budget Responsibility's own forecast and nearly £5 billion higher than the year before. Total public debt now sits at £2.9 trillion, or 94.2% of GDP. And this is where the trap closes, because higher yields raise the cost of new debt. Higher costs force more borrowing means more gilts flooding the market, and more supply pushes prices down, which pushes yields back up again. The Green Party's Zach Polanski gave it a name: the bond market doom loop. And what makes it even doomier is that this loop runs on autopilot. The UK holds a large stock of inflation-linked gilts, bonds whose payouts rise automatically with inflation. So, when the Iran conflict sent energy prices surging, Britain's interest bill rose by itself before the government made a single decision. Chancellor Rachel Reeves went into the year with roughly £24 billion of fiscal headroom, the cushion between her plans and her own rules. But Deutsche Bank's Sanjay Raja estimates more than half of that was wiped out by mid-May on higher yields alone. Pantheon Macroeconomics, meanwhile, reckons debt interest could run about £15 billion over budget if yields simply hold where they are. The House of Commons Library described Britain's chance of meeting its fiscal rules as, in essence, a coin toss. That stark assessment comes directly from the official Parliamentary Research Service describing the public finances of a G7 nation. And the IMF, in its May mission, warned that the British government has no real room left to add to its debt, urging it to stay the course. Now, before too long, the effects of all this are bound to hit ordinary Britons, and it looks like this summer could be the moment when this state-level crisis inevitably lands right on the kitchen table. That's because on the 1st of July, the Ofgem energy price cap will jump 13%, taking the typical dual fuel bill to £1,862 a year. Gas alone is up 24%. And the trigger? The same Iran conflict feeding the doom loop, choking the Strait of Hormuz and driving wholesale gas prices through the roof. Brent crude is sitting above $95 a barrel as I record this. But it doesn't stop in July. Cornwall Insight forecasts a further rise of around 2% for the winter quarter. So, the macro crisis you can't see in the gilt charts becomes the bill you absolutely can see on your doormat. And households are already drowning. Total energy debt across Great Britain has hit a record estimated at £4.4 billion and climbing, with some industry figures already putting it north of £5 billion. StepChange reports its average client now owes £2,646 in energy arrears, 1 in 4 of its clients spent more than a fifth of their entire net income just on energy in April. This is the macroeconomic transmission mechanism in its rawest form. A bond market premium in London becomes a freezing cold home in Manchester. But energy is just the bill people notice. The bigger squeeze is the one designed not to be noticed at all. You see, the UK's personal tax allowance is frozen at £12,570. The higher rate threshold is frozen at £50,270, and both stay frozen all the way to April 2031. Now that might sound harmless, but it really isn't, because as wages rise with inflation, frozen thresholds drag more and more people into tax they never used to pay. Economists call it fiscal drag, but we can just call it the stealth tax. The OBR projects this freeze will pull 5.2 million extra people into the income tax net by 2030 to 31, and it'll push another 4.8 million people into the higher rate band. Now, had thresholds simply risen with prices, the higher rate band would sit around £20,000 above where it currently is. The total haul from this freeze is forecast at £55.5 billion a year by 2030, making it, in effect, the largest tax rise of the decade. And nobody ever voted for it. The tax burden is now heading for 38% of GDP by 2030 to 31, the highest in modern British history. And this means that the people who can do something about it are doing the one thing the state can't stop. They're leaving. Around 1,800 non-DOMs left Britain after the April tax changes, a figure roughly 50% above the Treasury's own projections. The Sunday Times Rich List compiler Robert Watts called it a tale of two exoduses: foreign billionaires leaving and British nationals relocating to Dubai, Switzerland and Monaco. 1 in 6 of the names on the list 2 years ago have simply gone. Henley & Partners pegs the net outflow at 16,500 millionaires in 2025, which they describe as the steepest ever recorded for a developed economy. Wealth managers warn that as much as £100 billion of capital could ultimately follow them out. But the exodus at the top is only half the damage. Look at the bottom of the age curve and it's arguably worse. Over 1 million young people aged 16 to 24 are now classified as NEETs, that is, not in education, employment or training. That's 13.5%, the highest in over 12 years. And this isn't an attitude problem. 84% of them say they want to work, but entry-level jobs have fallen by around 1.6 million over 2 decades, and apprenticeship starts for the young are down 35% since 2017. The recent Milburn review puts the cost of this lost generation at £125 billion a year. Britain's NEET rate is now the second highest in Europe, behind only Romania. A decade ago, it sat near the average. And then there's the engine room of the state itself. The NHS waiting list still sits at 7.1 million treatments. The General Medical Council has flagged a notably greater number of doctors leaving practice, many citing hostility towards migrants in a workforce where 42% are trained abroad. So, wealth at the top, talent in the middle, youth at the bottom, all either leaving the country entirely or unable to find work and thereby contribute meaningfully to the state. Now, let's not get too carried away with the doom-mongering though, because the UK is not about to collapse in on itself, and some of the scariest framings out there simply don't hold up. For instance, the Office for National Statistics, or ONS, is clear that the fall in net migration, down from a peak of 944,000 to 171,000, is driven by fewer people arriving, not Britons fleeing. British net migration has stayed broadly stable. And when you actually ask the wealthy, the picture muddies further. A survey of UK millionaires found 88% are proud to live in Britain and 75% would happily pay more tax. And in a striking twist, they were more worried about doctors leaving than about other rich people leaving, 43% versus just 9%. Even the headline 16,500 millionaire departure is under 1% of Britain's total millionaire population. And cross-border wealth held in the City of London actually rose more than 10% last year. So no, the lights are not going out tonight, though the country is facing some tough challenges in the years ahead. The record stock market and G7 beating growth are arguably acting as an anaesthetic that prevents panic. Underneath the surface, the bond market is charging Britain a pre-2008 premium, while the state hands over £1 in every 12 just to service its debt. This macro crisis translates directly to July's leaping energy bills and a stealth tax dragging millions into higher brackets. As a result, capital and talent are drifting towards the door. The stealth winners are destinations like Dubai and Zurich, while the cost lands squarely on households facing rising price caps and graduates locked out of the job market. Now, Britain has faced adversity many times in its history, and with the right leadership taking the tough decisions, it can eventually weather this storm and come out the other side. But, to use a metaphor that perhaps befits a country that rose to glory by dominating the seas, it's currently navigating some very choppy waters. But what do you reckon? Does Britain muddle through this slow unwind and grow its way out of trouble, or does the doom loop tighten until the bond market forces a reckoning nobody in Westminster wants to think about? Let me know your thoughts in the comments down below. And if you want to understand how the very same fiscal pressures are tearing at the rest of the continent, you can check out our deep dive on Europe's decline right over here. That's all from me for today, though, so as always, thank you for watching, and I'll see you again very soon. This is Guy, signing off.